Good morning, everyone. I'm pleased to share another strong set of results which demonstrate the progress we're making towards our ambition to be one of the best performing, most trusted and respected consumer product companies in the world. Let me start by thanking all the Diageo employees for their role in making this happen. Diageo is a stronger company that is executing effectively against our 6 priorities. We are more consumer-centric, more efficient, and more agile. This is demonstrated in our performance, which has not only improved versus fiscal 16, but is also more consistent. Kathy will take you through the details of our progress on efficient growth and value creation, but let me take you through some of the highlights first. Organic net sales grew 4.3%, driven by volume growth and strong price mix, with broad-based growth across regions and categories. Organic operating margin expanded by 37 basis points, driven by our global productivity program and positive mix. We continued our strong cash generation with improvement in cash conversion and average working capital ratios. EPS is up significantly at 21%, driven by exchange benefits, organic growth, and higher associate income. We are raising our productivity savings goal to £700 million, with 2/3 being reinvested in the business. We continue to expect mid-single-digit top-line growth, but we are raising our margin improvement objective to 175 basis points for the 3 years ending fiscal 19. These results demonstrate the effective delivery of our strategy with sustainable top-line performance, consistent margin expansion, and a 3rd year of strong cash flow performance, which we expect to sustain through continued strong cash conversion. And today, we are announcing a share buyback program of up to £1.5 billion in fiscal 18. We operate in an industry with a natural runway for growth when compared to other consumer sectors. 4 years ago, I laid out our ambition to be one of the best performing, most trusted and respected consumer product companies in the world, delivered through 6 executional priorities and significant shifts in culture. While I'm pleased with the strong fiscal 17 results, I'm even more pleased that Diageo is now delivering consistent, efficient growth and value creation. Over the last 4 years, we've created a stronger and more agile business that's delivering sustainable top-line performance. Our productivity program has embedded the cultural shift to drive continuous improvement. We will constantly benchmark, identify areas of improvement, deliver against them, and then start the journey again. We have a strong track record of margin expansion with 120 basis points delivered in the 3 years prior to fiscal 17. And today, we have increased our productivity savings target to £700 million and raised our margin guidance for fiscal 17 to 19 to 175 basis points. We are very focused on consistent cash delivery with strong improvement over the past 3 years and intend to sustain strong operating cash conversion. We have a transparent and disciplined approach to capital structure and to how we prioritize the allocation of capital to maximize value for shareholders. Our primary focus is on investment in organic growth opportunities, which we now identify faster and more effectively. We regularly review our portfolio and have disposed non-core assets yielding over £1 billion, while allowing us to consolidate our beer position in Africa and trade Bushmills for 100% ownership of Don Julio. We will also pursue bolt-on acquisition opportunities that fit within our portfolio and can deliver attractive returns and strengthen our leadership position. In June, we announced the acquisition of Casamigos, the fastest growing super premium tequila brand in the US, which is an exciting opportunity to strengthen our position in the fast-growing tequila category, as well as expand the brand internationally. Casamigos has an authentic brand identity and is growing fast. We aim to sustain the momentum of the brand in partnership with the founders, who will continue to promote the brand and provide their leadership and vision. We have maintained dividend increases at 5% for the past 2 years as we rebuild dividend cover to our target range. And today, we've announced that we will return up to £1.5 billion of capital to shareholders in fiscal 18 through a share buyback program. The actions we have taken means Diageo is a stronger company today. We are not done. The team and I will continue as we move forward to find all the opportunities to drive growth and value for our shareholders. We have delivered consistent performance improvement over the past 2 years, and the improvement is broad-based across regions and categories. We've delivered this performance improvement while overcoming challenging operating conditions in some markets. In fiscal 17, we have entered the mid-single-digit growth range, and our focus now is to deliver it consistently as we build on the positive momentum in the business. We made good progress on our 3 fiscal 17 focus areas, and they've delivered almost half of our organic net sales growth. Including our performance in Europe, this number goes up to over 60%. In India, while we've continued to strengthen our business and brands, we've seen a particularly challenging environment with demonetization and the highway ban, the Supreme Court ruling banning alcohol sales within 500 meters of national and state highways. The experienced team in place that we have navigated these challenges with agility, growing net sales 2%, and growing market share. The progress we made on the fiscal 17 focus areas and the broad-based momentum across the business demonstrates the effective execution of our strategy. Our fiscal 17 performance also marks the first year of delivery of our medium-term guidance. While there is more to be done, this reinforces our confidence in delivering our guidance for mid-single-digit top-line growth and our revised guidance of 175 basis points of organic margin improvement in the 3 years ending fiscal 2019. And now, let me hand over to Kathy to cover these results in more detail.
Thank you, Ivan, and good morning, everyone. In the first year into our medium-term guidance, we've delivered a strong set of results that show good progress against all the measures we track to deliver efficient growth and value creation. Organic net sales growth was up 4.3%, in line with the first half, underpinned by 1.1% organic volume growth. Organic operating margin was up 37 basis points, driven by our productivity program, which enabled gross margin expansion, marketing efficiencies, and overhead savings. During the year, we also benefited from positive mix and category mix, with stronger growth in Scotch and Europe. Our discipline in converting cash and reducing working capital has enabled us to significantly improve free cash flow for the past 3 years, up £1.4 billion from fiscal 14 and up £566 million to £2.7 billion this year. We delivered strong EPS growth, up 21% excluding exceptional items, driven by favorable exchange and higher organic operating profit growth. The same factors improved our return on invested capital by nearly 2 percentage points compared to last year. Finally, TSR was up double-digit in the last 12 months, following a 17% increase in the prior year. A strong set of results that gives us confidence we can do even better as we look forward to the next few years. Let me take you through the numbers in more detail. Reported net sales were up 15%, as organic growth and positive exchange more than offset the impact from the disposal of non-core assets last year. Organic net sales growth was driven by 1.1% volume growth and 3.2% positive price mix. Volume growth was modestly impacted by short-term volatility in India, which I expect to ease in the second half of fiscal 18. Overall, pricing is muted across many of our markets, but mix remains strong. All regions delivered top-line organic growth. In North America, U.S. spirits net sales were up 3.4%, with shipment volume in line with depletions. Pricing remained muted. Net sales growth was driven by volume growth and mix, with strong contribution from North American whiskey and Scotch. Elsewhere, Captain Morgan net sales were up 4%, and we gained share in rum. Don Julio delivered another strong year of growth, outperforming the tequila category. Performance in vodka continued to be subdued, largely driven by Ciroc, whose performance was impacted by lapping the successful apple innovation with a smaller mango launch and a decline in legacy flavors. Momentum continued in Europe, Russia, and Turkey, where net sales were up 5%. Europe delivered another year of really solid growth, largely driven by our reserve brands, up 9%, and a strong performance from Captain Morgan and Baileys. Guinness net sales were also up 2%, supported by innovations from the Brewers Project. In Russia, net sales increased 7%, despite lapping a series of price increases in the previous year. And Turkey delivered net sales growth, although volume declined, as duty increases were passed on to consumers. Africa performance improved in the second half. Stronger performance in Nigeria was partially due to lapping a weaker comparative last year. Consumer confidence remains weak, and value beer remains the fastest-growing segment, where we're gaining share with Sassenbrau and Dubic. Elsewhere in the region, performance was consistent with the first half. In East Africa, growth in Senator was offset by weakness in bottled beer due to tax increases. Net sales growth in South Africa benefited from price increases, and in Africa regional markets, our business in Ethiopia continued to deliver solid growth. Spirits net sales growth in the region was stronger, up 13%, driven by a strong performance in mainstream spirits, which was up 21%. Latin America and Caribbean continued to deliver strong growth, driven by Mexico and Colombia, both up double digits. The consumer environment, although showing initial signs of improvement, remains challenging in Brazil, but performance improved in pub, largely driven by the second half, with Brazil lapping the impact of advanced purchases that occurred ahead of the tax increases in December 2015. In Asia Pacific, volume was negative, as declines in India, in travel retail in the Middle East, and in South Korea were partially offset by volume growth in other markets. Net sales in the region were up 3%. Greater China continued to deliver strong growth, up 25%, driven by the strong performance of Chinese white spirits and growth in Scotch. In Southeast Asia, Thailand improved in the second half, and Australia saw growth, both in spirits and the RTD portfolio. In India, where we continue to strengthen our prestige and above brands, net sales grew 2%, despite the impact of demonetization and the highway ban. We saw broad-based growth across all categories except vodka. Scotch and North America whiskey delivered half of Diageo's net sales growth. Scotch net sales were up 5%, with broad-based growth across most regions and brands. Johnnie Walker, Buchanan's, single malts, and primary Scotch drove our strong performance. Net sales in North American whiskey were up 11%, and we continue to gain share as Crown Royal and Bulleit both grew faster than the category. Vodka remains challenging, particularly in U.S. spirits, where competitive pressure is high in the category. Outside the U.S., vodka net sales were up 1.5%, as growth in Africa offset weakness in Brazil and Europe. In rum, Captain Morgan was in growth in every region. In liqueurs, Baileys was up 6% in Europe, its biggest market. We were quick to transfer the learnings on how we turned around its performance to the U.S., its second biggest market, where performance has already improved in the second half. India-made whiskey grew 6%. This reflects strong performance of the brands that we've relaunched over the last 18 months, McDowell's No. 1 Whiskey, Royal Challenge, and Signature, with all three brands growing faster than the category and gaining share. Elsewhere, Don Julio and Tanqueray drove net sales growth in tequila and gin, with net sales for those two brands up double-digit as they gained share in their categories. Beer is our second largest category, and net sales were up 2%. We saw improved performance in the second half, led by Africa, up 6%, driven by our value beer brands, Senator in East Africa and Sassenbrau in Nigeria. In Guinness, growth in Europe, North America, and LAC was offset by a decline in Nigeria, as well as Kenya, where bottled beer performance was impacted by duty increases. Net sales growth was broad-based across our portfolio of brands, highlighting Diageo's ability to deliver growth through both global and local brands. Global giants net sales were up 3%, with Johnnie Walker, Captain Morgan, Baileys, and Tanqueray Gin in growth in every region. Smirnoff net sales were down 1%, still challenged in a competitive vodka category in the U.S., and Guinness sales were flat. Local stars were up 9%, with a standout performance from Crown Royal in the U.S., Buchanan's in LAC, and Chinese white spirits in China. And finally, our reserve brands continued to deliver good performance, with net sales up 7%, with growth led by Chinese white spirits, Don Julio, and Bulleit. We continue to make good progress against our 3 focus areas, despite some specific challenges in India. Scotch net sales were up 5%. The improvement in performance was broad-based. We have a strategy that's working, and Ivan will share with you some examples of how we're putting that strategy into action. We're also increasing investment behind our brands, and I expect Scotch to continue its momentum in the next fiscal year. In U.S. spirits, net sales were up 3.4%, an improvement compared to last year, despite the overall market suffering from a slight slowdown in the second half. Over the last 18 months, we've made many changes to the way we operate in the U.S., and performance did improve. In fact, we're now gaining share in every key category except vodka, where our super premium vodka brands are driving the majority of the overall share losses. We have plans to improve, and Ivan will share them in a few minutes. Our productivity program allowed us to upweight investments in the U.S. spirits business in the second half, and we will continue to increase investments in fiscal 18. Next year, I expect overall performance to continue to improve. Net sales in India were up 2%. As anticipated, the business was impacted by demonetization in the first half and the highway ban in the second half. Our strategic priority in India is to grow brands in the prestige and above segment, which were up 7%, a good result given the volatility in the market. Our business in India has been very resilient and agile in adapting to the fast-changing consumer and regulatory environment. That said, net sales in India declined 5% in the last quarter due to the highway ban, and I expect it will continue to have an impact on performance in the first half of fiscal 18, although to a lesser extent. In July, the new goods and service tax became operational. While we are working on plans to mitigate it, I expect it to have a negative impact on margins in India in fiscal 18. Reported operating profit before exceptional items was up 19.7%, driven by positive exchange and organic growth. All regions contributed to organic operating profit growth and delivered organic margin expansion. At a consolidated level, organic operating profit grew 5.6%. Reported operating margin, excluding exceptional items, also benefited from positive exchange and organic margin expansion, and ended the year at 29.9%, 1.2 percentage points higher than last year. On an organic basis, operating margin expanded 37 basis points, with gross margin improvement, marketing spend efficiencies, and tight management of our overhead cost base, more than offsetting the negative impact from other operating expenses. Gross margin expanded 57 basis points. Supply efficiencies achieved during the year as part of our productivity program broadly offset cost of goods sold inflation, and gross margin also benefited from volume growth and positive mix. We continued to deliver efficiencies in our marketing spend, which drove 19 basis points of margin expansion, even though we significantly increased marketing spend in the second half. Let's dive into that for a minute before I close the discussion on margin. Looking more closely at marketing spend, you can see our underlying spend was up over 8% in the year, funded in large part from marketing efficiencies. This is really a great example of making our spend work harder for us, a real win-win for the business. Our biggest regions, North America and Europe, delivered more than 50% of those procurement efficiencies as a result of better pricing on media spend, continued consolidation of the agencies we use, and rationalization of our point-of-sale materials. We're not only driving efficiencies, our marketing spend is also more effective. As an example, on point of sale, we now have visibility to return on investment at a SKU level, allowing us to shift our point of sale spend to the most effective material. In Europe, we analyzed in detail the glassware we use to eliminate the least productive ones and focus on those with higher consumer engagement, such as the Guinness pint glass. This work generated nearly 4 million pounds of savings. As outlined at our Capital Markets Day, we are deploying our marketing catalyst system across our markets. This will ensure that our marketeers are equipped with better data to make faster and smarter choices on how to reallocate spend from one brand to another or from one growth driver to another, essentially enabling us to get a higher yield from our marketing spend. Coming back now to the other drivers of margin expansion. Overheads as a percent of net sales were down and delivered 55 basis points of margin expansion. This reduction in overheads was driven by savings on our indirect costs as a result of implementation of zero-based budgeting and our work on organizational effectiveness, which is increasing spans of control and reducing layers across the organization. Importantly, these savings more than offset restructuring costs and other costs that we incurred supporting our productivity work, which are no longer treated as exceptional. As you can see, we were also able to more than offset the negative impact of other operating expenses, which was largely driven by the fact that last year we had one-off gains from the sale of the UB shares and some surplus land. As Ivan already announced, we're increasing our margin expansion guidance from 100 basis points to 175 basis points for the 3 years ended fiscal 19. This is underpinned by additional productivity savings of 200 million pounds we expect to deliver. I'm really pleased with the progress that we've made in fiscal 17. This year, we've expanded organic operating margin by 37 basis points, with gross margin, marketing, and overhead efficiencies all contributing to it. A really good result and slightly above our expectations. We have built momentum and we've made great progress to embed a culture in the business that we can deliver more with less. People are more accountable for delivering continuous improvement through simplification and using better data to be more agile and move faster. This year, we have built improved capabilities on net revenue management, and we've codified our ways of working across our markets, allowing us to identify more opportunities. Our Center of Excellence in Europe is now fully resourced and operational, and it'll help us to accelerate how we build and improve capabilities. We've also made good progress on supply efficiencies through tramlining and through reviews of our footprint, which showed more opportunities than our initial plans. We're also deploying a new consistent approach to how we codify cost of goods sold across our markets, providing better internal and external benchmarks. At our recent Capital Markets Day, you heard from our Chief Marketing Officer, Sil Saller, on how we are rolling out our Catalyst system and how this new easy-to-access data-driven platform will help us to make more informed decisions on how we allocate marketing spend across our brands. We have been extremely quick to implement zero-based budgeting tools across markets and functions, and while this is now embedded in the way we build our plans, I have confidence we can further improve how we prioritize our spend. The leaner we are, the more agile we become. The work we are doing on organizational effectiveness showed there are more opportunities to leverage our shared service centers, especially the new one we've opened in Bangalore, and further reduce layers across the organization. In general, our continuous process of benchmarking both inside and outside of our industry is showing we can do more. We know the bar is moving, and we are clearly reaching for more. This is an ambitious productivity program, which in total will drive 700 million pounds of costs out of the business by fiscal 19. As previously indicated, 2/3 of these savings will be reinvested in the business, and approximately 1/3 will drop to the bottom line and underpin guidance to improve organic operating margin by 175 basis points. I expect the phasing of the remaining margin expansion we are now guiding to be more weighted to fiscal 19, as we have less costs to absorb and will get the full benefit from our investments to build improved NRM capabilities. Free cash flow delivery continued to be strong at £2.7 billion, up $566 million versus last year. The improvement was driven by favorable exchange, higher organic operating profit, and better working capital management. It's been really terrific to see our focus on cash consistently deliver strong results. This is the third year in a row our cash conversion is well over 100%, at 107% this year. Our keen focus on day-to-day working capital management yielded a 2.6 percentage point improvement in average working capital as a percentage of net sales this year. In fact, average working capital as a percentage of net sales has decreased 4.5 percentage points over the last 2 years, a testimony to our ongoing rigor in cash management. This year's positive impact of working capital on free cash flow was primarily driven by lower debtors, reflecting more efficient debtor management and reduction in overdue debt. Net CapEx was £472 million, $23 million higher compared to the same period last year. This is lower than the guidance we gave in January, primarily due to the phasing of projects. Next year, I expect net CapEx to be about £600 million, as we carry over some spend from fiscal 17 and we deliver strategic investments already announced, such as the new brewery in Kenya and the new Irish whiskey distillery in Dublin. Tax payments were £225 million higher year over year, reflecting both higher profits at a higher tax rate and the impact of exchange. Moving on to net debt, strong free cash flow was the key driver behind the £743 million reduction in net debt, which also drove lower interest charges. Our effective interest rate increased to 3.5%, broadly in line with our guidance as a result of the increase of U.S. LIBOR rates. Next year, I expect the effective interest rate to be broadly in line with fiscal 17. Our finance charges increased £17 million, driven by higher pension costs and the charge we took in the first half related to the increased valuation of the Zacapa put option. For the next year, I expect other finance charges to be broadly the same as fiscal 17, with the addition of the Casamigos earnout charge, subject to the closing of the transaction, being offset by reduced pension charges as a result of lower pension deficit. We have a transparent and disciplined approach to our capital structure and how we prioritize the allocation of capital to maximize value for shareholders. We target an adjusted net debt to EBITDA ratio, which includes our pension liabilities, of between 2.5 to 3 times. This enables us to consistently invest in the business, supporting both organic growth and bolt-on acquisitions, while achieving an efficient cost of capital. Our number one priority in allocating capital is to invest in the business where we see good returns. We regularly review our portfolio, and over the last 3 years, we've taken significant steps to simplify and focus on our core business. We sold the majority of our wine business, our non-core beer assets in Jamaica and Malaysia, and the Glen Eagles Hotel. At the same time, we consolidated our beer position in Africa and traded Bushmills for 100% control of Don Julio, as well as Smirnoff distribution in Mexico. We'll continue to look at inorganic opportunities to strengthen our position. We invest in nascent brands through Distill Ventures. This allows us to participate in founder-led brands in interesting categories with potential for future growth. We also continue to look at bolt-on acquisition opportunities. In June, we were pleased to announce the acquisition of Casamigos, which, as Ivan said, strengthens our position into the fast-growing tequila category in the U.S. The brand enjoys attractive gross margins, sits in the sweet spot in this exciting category, and over time we are confident that we'll be able to bring synergies and expand the brand internationally. The transaction is expected to close in the first half of fiscal 18. This is a great acquisition that we're confident will create value once it becomes part of the Diageo portfolio. We have a progressive dividend policy, and we expect to maintain a mid-single-digit increase until we rebuild dividend cover back to our target range. This year, the final dividend is 38.5 pence per share, up 5% from the previous year, bringing the full-year dividend to 62.2 pence per share. Our dividend cover has improved to 1.7 times. We remain committed to our stated leverage policy and a disciplined approach to capital allocation. We closed the year with an adjusted net debt to EBITDA ratio of 2.0 times, driven by continued strong cash flow performance. So as you've heard from Ivan, during the course of fiscal 18, we will return up to 1.5 billion pounds of capital to our shareholders in the form of a share buyback program. The devaluation of sterling following the results of the Brexit referendum in June last year had a positive impact on both net sales and operating profit, in line with our expectations. Using the rates presented in this slide, I expect exchange to continue to have a positive impact of about 70 million pounds on operating profit due to the unwind of our transactional hedging program, but a negative translational impact of about 80 million pounds on net sales due to the US dollar spot rate being higher than the average rate achieved in fiscal 17. Earnings per share before exceptional items increased 21% during the year. The favorable exchange, organic operating profit growth, and higher associate income more than offset the impact from higher tax payments and disposals of non-core assets. Our tax rate before exceptional items increased from 19% to 21%, consistent with our guidance. As for most multinationals, the current tax environment is creating increased levels of uncertainty. Our current expectation is that our tax rate before exceptional items will be approximately 21% in fiscal 18. We put some strong points up on the board against our ambition to deliver efficient growth and value creation. I'm pleased with the progress made, but also restless to strive for more. The momentum that we've built in the business gives me confidence we can deliver the higher medium-term guidance that we announced today, specifically 700 million pounds of productivity savings and 175 basis points of organic margin expansion for the 3 years ended fiscal 19. We continue to deliver strong results on cash. Our operating cash conversion metric is well above 100%, working capital as a percent of net sales continues to fall, and our free cash flow was up nearly 600 million pounds in the year. We ended the year below our target adjusted net debt to EBITDA ratio of between 2.5 and 3 times, and we will return up to 1.5 billion pounds of capital to shareholders in the form of a share buyback program during fiscal 18. I'm confident that the progress that we've made and the high-performance culture that we're building will continue to deliver strong results. Back to you now, Ivan.
Thank you, Kathy. Our results demonstrate the progress we're making on executing our strategy through our 6 priorities. Global giants account for 41% of our net sales and grew 3.4%. There is good momentum on Johnnie Walker, Captain Morgan, Baileys, and Tanqueray in their key markets. There's more work to be done to improve Smirnoff performance, specifically in the US. Beer continues to be a key priority. Net sales grew 2%, with Guinness net sales flat, and performance improving in the second half in Africa, where net sales were up 6%. In mainstream spirits, where we play selectively, we've made good progress in fiscal 17. I will cover India later. In Africa mainstream spirits, we were up 21%, with double-digit growth in our established mainstream businesses in Kenya and South Africa. In Nigeria, we made good progress on establishing a scale mainstream spirits business, tripling it as we broadened our mainstream spirits offering by innovating in whiskey, vodka, and gin. In Latin America and Caribbean, double-digit growth was driven by our lead primary Scotch brand, Black & White, as it continues strong share gains in the primary Scotch segment in Brazil and Mexico. Strong growth on reserve brands continued, growing high single-digit as we continued to execute our reserve business model, focusing on mass luxury, expanding outlet coverage, and the world-class program. Innovation continues to be a key growth driver, contributing 16% of fiscal 17 net sales. We had particular success with Crown Royal Vanilla in the US, which is recruiting multicultural and millennial consumers into the Crown Royal franchise. We have further strengthened our route to consumer in fiscal 17 through enhanced capability on 4 commercial standards, which ensure a consistent way to establish customer and outlet plans, measure performance, and incentivize our teams and our customers. I'm really pleased with the progress we've made on the productivity program so far. It's driving a focus on simplification and streamlining processes and using data and information better to be more agile and move faster in our decision-making. These changes are not one-off. They have changed our ways of working permanently and increased personal accountability for continuous improvement and faster decision-making across the Diageo. We have delivered the first year of our 3-year margin guidance, but also reinvested some of our productivity savings in the business. The progress we have made has given us the confidence to increase our productivity goal by an additional £200 million savings. Kathy shared the results on the first 2 measures that track the progress against our performance ambition. Let me share with you the progress we've made to become one of the most trusted and respected. Ensuring we make a positive contribution to society has always been a priority for Diageo and is at the core of our performance ambition. In fiscal 17, we continued to make progress on making a positive contribution to society and our 2020 sustainability and responsibility targets. We have fewer alcohol in society programs than in 2016 because we have concentrated our efforts on those that would have the biggest impact on the issues we aim to address. Employee safety continues to be an everyday priority for us. We're focused on markets in particular need of improvement to embed compliance to our core standards and programs. We continue to make good progress on our environmental KPIs, improving on carbon and water efficiency by 6% and 3% respectively. Employee engagement is a key metric to ensure we have engaged and empowered employees. Our annual employee value survey results shows employees feel very connected to Diageo. The progress we are making demonstrates our commitment to become one of the most trusted and respected consumer product companies in the world. Let me share some examples of our alcohol in society programs. Join the Pact is Johnnie Walker's long-standing responsible drinking program, inspiring consumers to pledge their commitment to never drink and drive. Over the past decade, we have been bringing this to life using Formula One as an aspirational platform, leveraging both Mika Häkkinen, 2-time world champion, and our Johnnie Walker responsible drinking ambassador, as well as the Formula One drivers of our sponsored teams, as credible ambassadors and role models to engage consumers at scale. In fiscal 17, we received 314,000 commitments to join the Pact. Smashed is a theater-based education program that aims to teach teenagers the dangers of underage drinking. It's a great example of where we have scaled up an existing successful program and rolled it out to other countries. The school-based program has reached 1,400 schools and over 300,000 young people in the 10 years since its inception, of which 135,000 were reached this year as we expanded the program from Great Britain to 6 more countries. The program covers topics such as legal purchase age, how to deal with peer pressure, and who to go to for support when dealing with issues related to alcohol. In fiscal 17, we conducted road safety workshops in Mexico, Nigeria, South Africa, and South Korea in partnership with the UN Institute for Training and Research. And in the Dominican Republic, we encouraged the passage of legislation that sets a maximum blood alcohol content for drivers for the first time. Moving to our three fiscal 17 focus areas, I'm very pleased with the progress we have made, but there is more to be done. These will continue to be focus areas for us in fiscal 18 as we drive further progress. Starting with Scotch. Scotch is about a quarter of Diageo's net sales, and we have built momentum in the category in fiscal 17. Johnnie Walker, our flagship Scotch brand, represents 55% of our Scotch net sales and is back in solid growth. Momentum has also accelerated on Buchanan's. Of the three biggest regions for Scotch malts, growth accelerated in Asia Pacific and North America. Europe growth slowed, driven by GB and Benelux. In GB, we gained share, growing 3 times faster than the malts category, but net sales were flat due to changes in commercial footprint. In Benelux, performance was impacted by a significant tax increase implemented in the first half of fiscal 16. In primary Scotch, we saw strong growth on Black & White, VAT 69, and Whitehorse, and Bell's performance improved. However, overall, performance slowed versus last year due to Black Dog being impacted by trading conditions in India. Other Scotch performance improved versus last year, but declines continued, driven by the decline of Windsor due to the Scotch category contraction in Korea. Let me share some examples of how we are driving Johnnie Walker and primary Scotches. Scale execution of Johnnie Walker's growth drivers is driving strong performance. In fiscal 17, we've been telling inspiring local stories of personal progress across the world, which have reached almost 180 million consumers. In fiscal 17, we used our Formula One partnership to sample and sell to 3.4 million visitors to the events every year. This will allow us to get liquid on lips of 1 million consumers in fiscal 18 and progress towards our 5 million Join the Pact commitments. We're also following up the success of Blender's Batch Red Rye Finish in recruiting new, younger legal purchase age consumers with Blender's Batch Wine Cask Finish, which has just started shipping. Though Johnnie Walker Blue Label is a pillar in our gifting strategy, we activate gifting across the portfolio. In fiscal 17, we delivered globally consistent execution across off-trade and multiple festive occasions, from Diwali, Christmas, New Year, Chinese New Year to Father's Day. Personalization of labels, a key component of our gifting activation, was activated in 33 countries and 59 cities. I'll now share with you how the activation of the 4 growth drivers is driving strong Johnnie Walker growth in the United States. The Keep Walking America campaign was launched on the eve of the presidential election and celebrates American diversity and encourages progress. By being bold and brave and leaning into the relevant cultural conversation, we've engaged a new generation of drinkers and set the stage for long-term growth. In the second half, we partnered with the Los Angeles soul band Chicano Batman to launch the next phase of the campaign. And we've leveraged the campaign even further in the US. By creating localized Keep Walking assets, we bring the striding man into the neighborhoods of millions of people. Keep Walking Yankees is a partnership with the New York Yankees with localized Keep Walking touchpoints at Yankee Stadium and a limited edition bottle to celebrate one of the iconic symbols in baseball. Yankee Stadium alone attracts over 3 million fans every season. The campaign is driving strong improvement in brand equity measures. We know liquid on lips drives at least 20% conversion to purchase, and in the US, we've been sampling consumers at culturally relevant events like Coachella. Johnnie Walker headed to the California desert for an unforgettable weekend during the Coachella Music Festival. For the first time, the brand was front and center at some of the hottest parties and hosted a one-of-a-kind skywriting stunt over the festival grounds that had everyone talking about Johnnie Walker. Johnnie Walker showcased that light, fresh, and delicious Johnnie and soda cocktails were the perfect way to escape the Coachella heat. We sampled Johnny and Ginger at the Austin Grand Prix, which was attended by 240,000. And in the second half, we launched Blender's Batch Triple Grain American Oak in the US. Aged for at least 10 years in American oak, including bourbon casks, it is crafted using 5 whiskeys, including grain from the now closed Port Dundas distillery and malt from Mortlack on Speyside. The result is a whiskey that's uniquely smooth, with notes of sweet, fresh fruit and gentle spice. This Father's Day, Johnnie Walker hosted a Father's Day gifting studio on the floor of the state-of-the-art Oculus at the World Trade Center in New York City. The activation ran for 2 weeks and provided visitors to this iconic transportation and shopping hub with complimentary Blue Label engraving and Johnnie Walker trademark personalization. The physical activation was seen by over 3 million visitors. Bottle fulfillment was facilitated by our partner Drizzly and allowed consumers to receive their bottles at the venue or by same-day delivery within Manhattan and surrounding areas. The learnings from this activation will allow us to scale up this trademark gifting approach in fiscal 18. Scotch retains an aspirational role in emerging markets as the preeminent international premium spirit. However, recruitment depends on affordability, and it is led by the lower-priced primary Scotch segment. We have the brands, and we have the liquid to play a bigger role in this segment. Black and White from the House of Buchanan's is our priority in Latin America, and we saw strong growth continue in fiscal 17, delivered by exceptional performance in Mexico and Brazil. VAT 69, Bell's, and Whitehorse all improved performance versus last year. Let me share with you the success we've had in Brazil with Black and White. The Scotch category has been impacted as consumers trade down in the challenging economic environment. Consumers are looking for quality credentials in Scotch at affordable price points, and that's what Black and White offers. We established Black and White's quality credentials through targeted media investment, driving in-store visibility with displays highlighting the affordable price point, and coupled with strong on-premise activation. Black and White is now the biggest primary Scotch brand in Brazil and is driving our share gains in the Scotch category. Turning now to US spirits, our second focus area. We've strengthened our understanding of the consumer and their shifting attitudes and behaviors. This defines what we need to do to win. We must win with the 3 major consumer cohorts: millennial, multicultural, and ageless consumers, by targeting the right consumer occasions with communications that are purposeful whilst considering their shifting attitudes, and ensuring our brands stand out wherever they choose to consume spirits or look for information to make consumption choices, such as on-premise, digital, or third spaces. We've been executing against our strategy with pace. We now have purpose-led marketing communication platforms for all our major brands. We activated against the multicultural consumer at scale, with fiscal 17 spend more than 4 times what we spent last year. We are using search and always-on digital content to connect at the point of purchase. We've enhanced our on-premise route to consumer with the 200-person activation army that's been in place for 2 years now, targeting over 7,000 on-premise millennial accounts. These accounts are growing 10% faster than the rest of the market. We've added 65 reserve ambassadors in the first half, focused on over 1,400 trend-leading accounts. And we are leveraging partnerships with the likes of Drizzly, Uber, and Tasty to amplify our brands. We are leading the spirits industry innovation, driving fewer, bigger, and more sustainable ideas, and by nurturing smaller, earlier-stage brands. Over the past 12 months, while we have launched 11% of the industry's innovation variants, these make up over 60% of industry year 1 innovation retail sales. And finally, we continue to drive efficiencies in our costs in order to reinvest savings into the business to drive growth, upweighting investment in the second half on key brands. These actions are driving improved performance on core brands and continued momentum on our fast-growing brands, Bulleit, Don Julio, and Buchanan's. However, overall fiscal 17 performance was held back by super premium vodka performance. Excluding Ketel One and Ciroc, net sales grew 6.1%. We've made good progress in improving the performance of our core brands. These represent over 50% of our business and grew 6.3% in fiscal 17. Share gains were achieved in all key categories except vodka. The strong growth and share gains for Crown Royal have continued, with the base variant Deluxe and Regal Apple in growth. Vanilla is the #1 innovation in Nielsen and NABCA. Johnnie Walker, Captain Morgan, and Baileys also improved versus last year. Smirnoff depletion volume was flat, but net sales declined as we continued inventory management initiatives and finished making the necessary price adjustments. The actions we've taken on the brand are driving improvement in brand equity scores and recruiting new consumers. We remain confident in bringing it back to growth. Ciroc and Ketel One performance has softened, and we believe we have the right plans in place to address this performance. We will continue to improve our performance in fiscal 18 with our strong plans supported by an upweight in investment. Core brands are key to our success, and our goal is to sustain the trend on these brands. We are making interventions to stabilize super premium vodka. Ketel One has laudable quality credentials, backed up by years of awards, and with a family recipe still produced by the family. We've launched a new consumer communication platform designed to reinforce brand quality and heritage credentials. We will increase weight of our communications targeted to female and ageless cohorts. For Ciroc, we are establishing a platform that drives sustainable growth for the brand through the core variant and flavor range. We are expanding consumer recruitment to urban Hispanics and introducing additional influencers to the brand, like DJ Khaled and French Montana. And bringing new news to the brand through expanding Ciroc into the summer entertaining occasion with the brand's first limited time offer, Summer Colada, which sold out quickly through online summer drink recipes and a special pack for flavors. And opening up the brand to new occasions and serves with the launch of a new variant. Aside from super premium vodka, our reserve brands have continued to grow at double-digit rates. Our plans will maintain the strong growth. Our portfolio brands' volume performance has improved through the interventions we made, and we have plans in place to further improve the performance in fiscal 18. And innovation will continue to be a key growth driver as we deliver fewer, bigger, and more sustainable ideas. I am pleased with the progress in India despite the short-term headwinds we faced from demonetization and the highway ban, which has slowed growth in fiscal 17. Strong growth continued on prestige and above brands, driven by the success we've seen behind the relaunches of USL's power brands and the strong performance in Scotch. We gained over 20 basis points of spirits industry share in the 12 months through May, with prestige and above brands gaining over 70 basis points of industry share. The highway ban impacted second half performance, and the impact is expected to continue to a lesser extent in the first half of fiscal 18. We also made progress towards our goal to improve operating margins, with gross margin improving by 56 basis points, driven by positive mix, price increases, and supply productivity savings. Excluding productivity-related costs, overheads reduced by 1% as we implemented zero-based budgeting and took actions to right-size the organization. These productivity savings were partially reinvested to support relaunch of Signature and the increased activity behind Scotch. India's goods and services tax went live on July 1st. While the impact of increase in input costs was lower than expected due to extra neutral alcohol being excluded from GST, there is still an impact due to higher tax rates on packaging material, molasses, and services. We're currently working through options to mitigate the impact, but we do expect margin impact from GST in fiscal 18. We remain committed to delivering our medium-term goal of improving organic operating margin to the mid to high teens. Let me close by saying the shifts we have made over the past 4 years have made Diageo a stronger company. We have created a high-performing culture that is even more consumer-centric. We have the right talent with clear accountabilities and a more disciplined and agile organization that is more data and insight-driven. We have intense, everyday focus on efficiency that's providing the fuel to reinvest behind our brands. There is momentum in the business, and the performance improvement is broad-based. We have delivered the first year of our medium-term guidance with consistent, strong, free cash flow. I am confident about the future with the progress we've made and this strong set of results. As a result, we have accelerated our productivity savings and increased our goal to £700 million. We have raised our medium-term operating margin expansion objective by 75 basis points, and we have announced a share buyback program of up to £1.5 billion in fiscal 18. We are on track with our long-term performance ambition to be one of the best performing, most trusted and respected consumer product companies in the world. Thank you.